Kevin, great to speak with you. And I know that you have been taking money out of regional banks and have actually said, let some of them fail. They are not in a good position and maybe they shouldn't be around. If that's the case, their assets, their deposits end up going to the big banks. Is it better to have more bigger banks?
Well, actually, it is. It's a proven model in many countries. And England has about 300, Canada has 6, Australia the same, small number. They're behemoths, but it occurred over time, and that's going to happen here. The reasons for regional banks that were important 60 or 100 years ago, due to the differentiation of the economy in different parts of the country, makes no sense anymore because we have digital banking. 97, 98% of banking is done online. But the real issue is the lack of confidence in the management of. Remember, we started with 20,000 regional banks. We're down to 4,500. What percentage of these banks are run by idiots? We don't know. And so each week it's a rolling disclosure of an upside-down balance sheet, poor management. Remember, a lot of these managers never lived through a period of a rapid rising interest rate. Their balance sheet's upside down. The story is well known. But the real heart of the issue is, and I've told this to all of our portfolio companies, give me a reason that you would keep any of the cash that I invested in your company in a regional bank. That's question number one. Why? Why do I have to put any cash at risk? Get it out of there, move it into one of the major money center banks. Otherwise, we won't lend you any more or buy any more of your equity. And I'm not the only person doing this. This is happening every single hour.
So, Kevin, let me ask you, because obviously you're in close contact with the startup community, having invested in them directly. What has the collapse of Silicon Valley Bank and now First Republic meant for the startup community? Did it create any kind of vacuum, or were the regional banks already, or were plenty of other banks already serving these startups?
Well, there were some very attractive rates by Silicon Valley Bank to the CEOs of the startups. It was well known in the Valley, the jumbo mortgages, all the rest of it. But again, and there's no easy way to say this, run by idiots. It went to zero because of poor management. So I'm going to guess that 15% of the 4,500 will go to zero on their own because of poor management. And then the market will question, why do we need all these banks? We'll end up in the next 3-4 years down to some super regionals, maybe 800, maybe 600. I don't know. I have no idea. But let the market be the market. I certainly, as a taxpayer, don't want to guarantee idiot management. Yeah. That's a bad outcome. Everybody knows that. And that's why the Fed has really been talking about this around the edges. They're not guaranteeing every single deposit over $250,000. And they're certainly not going to guarantee the equity of regional banks. And let the ones that are run by idiots go to zero. Every other sector gets rid of it. It culls bad management. That's the great thing about the markets. It finds the bad managers, culls them, and eliminates them. We have to let that happen here. Well, so many idiot managers in banking.
Well, we see the process unfolding here, Kevin, and we know that it's going to probably be some time before we get to that final resolution. From your perspective, and more importantly, from an investor's perspective, how do you manage through, I guess, the interim? The idea that whatever the end result is, there's going to be a lot of volatility, a lot of uncertainty in between. Maybe lending conditions tighten up even further. How does that affect what you're doing?
Well, that is the question. You're 100% right. So what we've seen over the last 6 weeks, I wouldn't use the word tightening. It's gone. You can't borrow anymore if you're, a small business, sort of 5 to 500 million in sales. It's virtually impossible. The shadow banking market, the $1.2 trillion family offices and hedge funds, they're offering capital now, but at double-digit rates. And so we're in a really tough situation here, and it really hasn't had impact yet on the economy. Remember, 68% of the economy in America is driven by small business, the kinds of companies I invest in and many others do. Right. We talk to our CEOs every week. It's not that it's slowed down. It's 100% dried up. There is no money right now for small business. And I have urged every one of my companies to go and pursue every single grant and loan they can get from the government that was put in place. Right. And the big program that no one's heard of, that's actually still in existence, that we've tapped, is the employee retention credit. We have gone there and raised millions of dollars for small business they didn't even know they were eligible for, and that cost of capital zero. We have to find every dollar we can find, because the banks are not lending.
So they're not lending. Have you advised any of those companies to move their money, to move their deposits out of any of the banks that they did have relationships with?
Not some of them, all of them. Every single one of them. We have scraped it clean. I'm just being honest with you that nobody's going to put money into a regional bank when they know it could be one of the ones that goes to zero next week. So why would you do that?
I understand that. So what are your businesses doing? I mean, I understand, okay, they're looking for some of these programs to maybe float them. How is business doing overall? Meaning, just take out the financing needs right now in terms of what they're selling, in terms of the demand that they're getting from their customer base here. How is that holding up right now?
That is the incredible situation we face. Imagine this. We, along with everybody else, look at the tear sheets every week, and that's revenue and free cash flow, waiting for the recession. We're waiting for Godot. And the challenge for us is we have to put capital to work in inventory for every 90-day cycle. So if we've got a product that's selling, we have to build more of it. We have to be able to finance that, and we have to have it on hand when people demand it. Half of the business is now direct to consumer, half is to retail. We're waiting for the recession. Where is the recession? And so our problem is we're trying to be very, very careful with this capital, waiting for the slowdown. So to the extent we get capital, maybe through the ERC loan or something else, we borrow it privately in the shadow banking market, we are really having a hard time trying to forecast the next 90 days. The remarkable situation is we're at full employment. We have not seen the slowdown in the consumer yet. We are still selling at record rates, and everybody tells me every day we're going into recession.
But
where is it?
Kevin, there's no part of your portfolio where you're seeing a little bit of wobbliness, a little bit of weakness, a little bit of a sign that perhaps things are going to start pulling back more?
Yes, regional banks. Those are the ones. Those are the ones that have actually been affected by the rate hikes more than any other sector. Remember, we have 11 sectors of the S&P. Financial services is the only sector that services all other 10. And we have just discovered that our banking system doesn't match reality. We don't need 4,500 regional banks. The market is doing its job in squeezing out the weakness and the idiot managers. That is traumatic. But businesses and consumer services right now have not showed the slowdown yet, and that is the dilemma our economy has. That's why we're having such a difficult time. Inflation's still up there at over 4%. I see it in my raw product costs,
and that is something
costs.
And that is something the Fed will have to contend with, and we will continue to deliberate. Kevin, thank you so much.